Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I joined today by my trusty sidekick and co-host, Scott Sage. Scott, good to see you again.
Great to see you. I like this new format we have here. I think you just introduced a cold open for the podcast.
Yeah, so we were hanging out this week in sunny Las Vegas at the VRMA conference. How was the show for you?
The show was good. It was always a good time when I get to connect with other managers, other partners in the space, a lot of good people there. So yeah, I think what's the phrase? What happens in Vegas stays in Vegas. But we're gonna break that. We're gonna break that today because let's actually talk about what happened in Vegas, at least at VRMA. What were your, let's call it, two main takeaways leaving the conference?
Yeah, my first one was AI is here and it is rocking. The number of AI companies that were in the exhibit hall was incredible. I loved getting demos of the ways that people were leveraging AI and bringing it into the host ecosystem. Me personally, I've been waiting for some awesome release from Airbnb on how they're just going to leverage AI and make hosting amazing. And I think my takeaway is if we keep waiting for Airbnb or Vrbo or Booking, we're probably going to be holding our breath for a while. And it's up to the ecosystem to get in and build the next version of hosting tech. And it was exciting to see. And then we had a number or some data in my presentation that I think supported it on how review scores had changed most over the past year. And the only thing that's really changed in the past 12 months is for large property managers, their scores for communication have increased meaningfully. So is that AI? Is it that they just heard that they're doing a bad job? Is it something else? Who knows? But I think it's a interesting trend that we're seeing in the data set. What about you?
No, I think it's a great take. Everywhere I walked through this exhibit hall is .ai or something AI, which is, I think, generally good for the industry. My two takeaways, Jamie. Number one, the booth exhibits just keep getting taken to the next level. Next to the AirDNA booth this year was a puppy adoption zone. So that was a good distraction throughout the conference. But actually, I left being quite impressed with the sophistication and professionalization that has continued to grow within our industry. As I talk to different operators, the level of professional growth mindedness that exists around building sales teams and finding leads and acquiring new inventory and focused on retention and metrics and analyzing their business. As I talk to different operators, it feels like even in the past 12 months has become even more professional. Maybe AI is something with that. But the other takeaway I had, Jamie, was a number. And that number is 4.7. I think you know where I'm going with this because you gave this number to the VRMA audience, which is if you're a professional property manager, you damn better be above a 4.7 if you plan to keep your clients.
Yeah, that was a fun number. I digging into that research beforehand, I'll sort of share the impetus here of and we've built this new PM tool, property manager tool at AirDNA, and we're trying to dig into some of the underlying research of and what are the reasons why property managers should be tracking a lot of these different metrics. And with review scores, we all know review scores are meaningful. They help us move higher up in the rankings. They theoretically help us drive higher RevPAR. But what do we see in terms of the actual data? And one of the clear ones was around retention. So we broke out churn profiles of hosts and property management companies that had a review score of greater than a 4.7 and those that had one of lower than a 4.7. And in my head, I've just always been told the rule of thumb is 10% churn is sort of normal for a property management company. That's about average. And when I ran the numbers for 2019, we saw 11% churn. And that was true for both property managers above a 4.7 and below a 4.7. I'm like, oh yeah, that rule of thumb seems to hold pretty well. And then you fast forward to 2024 and you look at the level of churn for those above a 4.7 review score. You see a churn rate of 9%, which is like, oh, that's great. Like, and churn's reducing, they're doing well, and it still sort of aligns in with that 10% churn metric. But then you look at property managers that have a review score of a 4.7 and below, the level of churn now is on an annualized basis, 24%, which that's more than 2x, 2 times the level of churn. So clearly there's something happened in the marketplace that has led to this reduced level of churn for underperforming property managers. And I think it is what we've seen during COVID of the best are doing better, the worst are sort of coming out of the pack. And then the changes that we've seen in the OTAs. So where they are really promoting the best performing properties, and Airbnb's released their whole new set of badges. We've got guest favorites now. We've got the top 10%, top 5%, top 1%. Vrbo's changing their premier host to be at a listing level, and they're rolling out their sort of top badges for the top 10%, top 1%. And those play heavily into search on the OTAs on which properties are going to show to the top. And our research does show that, and the difference between an average property and a 5-star property is almost 15% in terms of RevPAR. So if you're not getting the properties towards the top, especially if you're a property manager, then you're going to start losing your owners, you're going to start losing your clients, and that's going to dramatically increase your churn.
Especially coupled with the fact that as there's increased competition in the marketplace, so there's added supply, it's harder to find that margin if you're not showing up in the rankings. And there's added competition with more professional managers in the marketplace. And so if you're a homeowner, Jamie, you now have more optionality. So if your revenue goes down year over year, quarter over quarter, you might start looking around. And on the point around listings and the growth of listings and listing size, you also shared some interesting data around the distribution of host size and how that's changed over the prior few years.
Yeah, so there we looked at and essentially the difference in total listings sort of distributed between large property managers and individual hosts. So large sort of named property managers in our data set has been and remains to be, like in coastal mountain markets, about 37% of listings. Those managed by individual host has actually decreased from 52% of listings in 2019 down to 46%. And we've seen this emerging middle of sort of non-named. So like it's still like Scott Sage's like co-hosting company. And a lot of them are co-hosts, a lot of them sort of small property managers. But you didn't ask for it, but it goes into my second sort of big takeaway from the conference was that national is dead and local is king. In that it was a themes through so many different presentations that if you don't have local ownership, local control, that you just can't win in this space. And with these co-hosting companies, we see, and they are hyper local. They are managing like 6 to 20 properties. They're in one, maybe two submarkets even, and they're generating excellent reviews, high review scores, and this is by far the fastest growing type of host in the business today.
The pendulum has swung quite a bit there, Jamie. I think back as even recent as 22, 21, maybe even in 23, hearing managers in this space talk about building a national brand, building a loyalty program that scale, they want to be a Marriott or Hyatt for short-term rentals and Airbnbs. And so far, that has basically proven to be unsuccessful anywhere you look. There are a few outliers who have reached scale, but even those have local operators and local brands. So, it's a really interesting model, and the data shows it. Those small operators are the ones that are growing. A 3% growth for the large operators, I think you used the word anemic.
Yeah.
We think we're in a growth industry, but if you're growing 3%, that's anemic. So I completely agree. Local wins.
Yeah, since you mentioned it, I'll call out because I talked about it up on stage. Like you don't need to be national to have a loyalty program. And I had interviewed this property manager for that runs Red Cottage in the Lower Hudson Valley, and like they've launched and really successfully a loyalty program. It's like $500 a year, which is not cheap, but and it gives people like discounted nightly rates, like 10% off, no pet fees, early check-in, check-out, like extended booking windows. They let you book 3 months earlier. So like they're getting all this incremental revenue to their property management company in the terms of this and people paying into this loyalty system for a lot of things that you're going to give away anyway. Like if someone calls and wants a 10% discount, you're probably getting it. If someone's looking for, and they've been a loyal customer and they want you to waive the early check-in fee, you're probably doing it. Like letting you book even earlier, and something that you're going to do anyway. So a lot of these things, like you're able to read the market. If you're getting a lot of repeat bookings, like this notion that you've got to rely on Vrbo's One Key program or Booking's Genius program or whatever loyalty program that Airbnb is going to announce next year, like you can do it yourself and you can do it successfully.
Yeah. I mean, look, and arguably a local loyalty program has a better adoption rate and maybe even a higher willingness to pay for vacationers who likely repeat their travel to the same place and want to stay in the same place with the family home with their family. And so it's a great opportunity to capture that local market and win in your local market. So it's a really astute point. All right, Jamie, you also shared market data on stage. And so maybe you can give a little snapshot to our listeners here who maybe didn't have the chance to get to VRMA. So let's dig into the September data, kind of pick our heads up, look at what we've seen for the year to date and what we're going to see for the rest of this year. So let's maybe start with September and sort of muted performance, maybe marking the first year-over-year decline in demand. Okay, 0.1%, but it still is decline since April of 24.
Yeah. So we talked about this a little bit last month of this calendar quirk for September. We essentially got one day of Labor Day weekend that switched from September into August. Last month, August, we saw demand growth of 3.8%, which was some of the highest we'd seen in the past few months. Occupancy only decreased by 0.9%. And we see the subsequent impact of that in September with demand slightly down, occupancy down almost 4%. So I'm going to say, like Scott, for August and September, we're going to combine the 2 months. We're going to divide them by 2. And that's like our summer performance. So demand was up about 2%. Occupancy was down about 2%. That's not great. It's a little bit worse. And the summer had been trending, demand up about 3% from May, June, and July. Occupancy had been trending down about 1%. So not a great into the summer. Just about every single location type was down this summer pretty significantly. So this absolutely wasn't the summer we were hoped for at the beginning of the year. And we've seen the ongoing impact of tariffs, uncertainty, and inflation starting to pick back up, a lack of job growth. So yeah, there's a lot of worry out there about the overall economy. But Scott, have you looked at the stock market lately?
I have.
And another record this week.
A lot of green.
A lot of green, Bitcoin, gold, and I don't know. you probably would just put all your money in your mattress
Yeah.
and hope that inflation doesn't get too high. Uh,
Yeah, I mean, you bring up a good point because you ask at this basically the last 4 presentations I've seen you give, you start with, "How are you feeling about the economy?" Well, have you checked your stock portfolio? And I think implicit in that is there's this dislocation between a market ripping and people not feeling like they have that same ability to spend or feeling comfortable with their cash position or whatever it may be. And even as you're just talking about this, it's like, well, the market growing and seeing green on my index funds is really just 7 to 10 companies riding this AI wave. And so that doesn't necessarily translate to our industry. It doesn't necessarily translate to what's happening with short-term rentals and guests wanting to go travel domestically or internationally. And we see that in the data here. So that's why I think it's a really important point to separate between what's going on in the stock market versus what's actually happening with the people coming and staying in our properties.
and maybe if you're a real estate agent in Tahoe, sort of selling vacation homes to all those new billionaire employees from NVIDIA or Google.
Then you're
But
probably feeling good.
yeah, in general, and this is a theme we see across really all aspects of the economy. Like there is the top 10% of income earners that are doing really well. Those are people that are invested in the stock market, probably invested in Bitcoin. They're diversified across a lot of different exposure. They own their home. They're not seeing increases or a ton of increase in their expenses. They've got an increasing disposable income, and like research has shown, they're driving 50% of overall consumer spending in the US market today. Then there's the rest of the 90% of the market that's being squeezed by inflation. They're running small businesses and they're seeing increased worker expense. They're having a harder time finding workers, so they're having to pay their workers more. They're seeing a lot of the members of their community sort of cut back on spending because companies aren't hiring. They're unwilling to hire themselves. And we see disposable income for the rest of the 90% continue to get eroded by higher prices. And we see sentiment really weak for large swaths of consumers. And that's really weighing on both consumer spending, and which has essentially been stalled since January, and on just willingness to plan too far in advance, because you don't want to get into the situation where you've booked a vacation, you've booked your flights, and then you get laid off or something changes in your sort of personal sort of finances where now you can't afford that trip. So we see a real pause and willingness to make far out decisions, and just a lot of negative sentiment towards where the economy might be going in the near term.
Not all bad news though. If you're an existing operator, we did see demand stay relatively flat, and perhaps the lagging indicator of a slower summer is we saw total listings decline year over year, about a little north of 4%. The downstream effect of that, ADRs
I'll
climbed.
I'll note listings in decline. We saw the new listings sort of drop. So overall supply growth was up about 3%. We saw new listings drop a bit. So we're still seeing a weakening supply growth. It is still growing, but as you were about to say, like the weakening occupancy trends that we've seen this summer are starting to erode some of the strong ADR growth that we had been seeing earlier in the year.
That's right. That's right. And so as we think about how Q4 rounds out 2025, what is your perspective in terms of how 25 will finish and what the early half, I won't ask you for a full year prediction, but early half of 26 might look like?
Yeah. I'll ask you, do you have Christmas, New Year's plans yet this year?
I don't yet.
So one of the exciting things this year compared to last year is that New Year's Day is on a Thursday. So do you remember what New Year's Day was on last year?
Wednesday. So this is maybe my biggest takeaway of talking to you on a regular basis
Yeah.
is there's always a story behind the data, and maybe the number one story of short-term rental data is where a holiday falls.
Yeah.
We talked about it in this episode, maybe every other episode of the calendar shift, and now we see this with the end of the year holidays.
And it's why pacing data is just so important. Cause like looking at the pacing data sort of illuminates what these calendar shifts do. And like you think about just like the psychology of pricing, like, oh yeah, New Year's happens every year. Like I'm going to increase my price. Like then last year when it was on a Wednesday, there was just like almost no demand. Like we did talk about like people that were going to take the week took the week, but like no one just took the long weekend because there was no long weekend to like attach it to since New Year's Eve fell on a Wednesday or New Year's Day fell on a Wednesday. So this year with it on a Thursday, on New Year's Eve this year compared to last year, we're seeing demand up 40%, which is crazy. We actually see the whole second week this year, and going from Christmas on the week of the 22nd to New Year's the week of the 29th, and pacing up really strong because people are sort of changing their travel habits because of how the holidays fall. And this is where it's not like, oh, it's just a calendar shift this time, like we saw from August to September, because really no one really cares if it's part of August or part of September, but people do really care that I can take off New Year's Day or get New Year's Day off. I can just take one day off on that Friday and get a nice 4-day weekend. And we're seeing that and bring in incremental demand, more and more people taking vacations around New Year's this year compared to last.
So you're saying I should probably go book something this weekend.
That was my hint, that if you're gonna plan a trip for that week or that long weekend, like go ahead and do it because demand is way up. And if you're thinking about how you're going to price your short-term rental and you cut New Year's last year, this might be a year to sort of maybe move back to more normal New Year's Eve pricing.
And so I think that's a really good point, Jamie, in terms of, yeah, we can talk about calendar shift and holiday timing and pacing and all that. What does it tactically mean for you as a host or an operator? This is why it matters is you shouldn't adjust or drop pricing. You should hold strong if you can understand the consumer behavior, actually see that data that demand is up 40% gives you way more pricing power.
Yep. And obviously that's going to depend and vary by market.
Markets, of course.
We'll talk more next month about the markets that we're seeing and stronger pacing around New Year's, weaker pacing around New Year's. We are seeing some interesting trends around in Thanksgiving this year with the markets that are seeing sort of increased or decreased pacing. I thought it was sort of interesting, the markets that we're seeing and really strong pacing around Thanksgiving because it is fall. Most of them sit around football games. So markets that maybe didn't have a New Year or Thanksgiving week game this year are seeing it, or last year seeing it this year. So Gainesville, Florida, Columbia, South Carolina, Ann Arbor, Michigan, seeing really strong demand pacing because of big football games coming up.
That would make sense. Probably see that. Might even see that around some of those NFL cities too, having Thanksgiving Day games.
Yep. And then the other fun one, and this is I feel like a press highlight every year, is pulling data around leaf peeping. And the team, and maybe we'll get a visual into the video, but if not, people can go to our September review blog on the AirDNA site. And we've got this fun visual on how occupancy sort of moves down the East Coast as you progress through the weeks, as the sort of leaves change further and further south throughout October. So early October, great demand up in the Northeast. And then by the end of October, early November, you're seeing it all move down south. So yeah, it's strong demand in North Georgia, where I've got my property, early November, and then early October up and it's sort of past it now in sort of Maine, New Hampshire, Vermont area where I think we're past now sort of peak
Peak.
leaf peeping time there. Say that 5 times fast.
Will you be doing any leaf peeping this year?
Yes, but not for leaf peeping. I will be going up to the house. I got a guys weekend up in early November. So yeah, we'll be experiencing the leaves firsthand. And I'll be personally blowing the leaves.
Yeah. Taking care of
as
the
well.
property. That's right.
Yeah.
Awesome. Jamie, any final thoughts here to wrap up September performance?
I'll say, and we sort of hinted to it on the sort of, I'm talking about the holidays, but we are seeing stronger pacing heading into fall. And October is a little weak, and it's sort of actually right in line with what we saw in August and September. But we are seeing pacing accelerate a bit in November and December. So that gives me some hope with some normalized booking windows that maybe we're getting through some of this uncertainty and people are starting to feel more comfortable that cooler heads are going to prevail on tariffs and that we're not going to be going into a full-on trade war. And then, and as you say that, you look forward into Q1 and demand it's growing, and it's more in that 1% to 2% range. And then all eyes on December, and we'll talk about it more in depth maybe next month. But the upcoming World Cup, which is clearly adding to demand next summer. June and July is going to be really big for 12 markets in the U.S. But also, I expect we're going to see increased international demand throughout the country as people sort of plan trips that are coming into the U.S. For the tournament.
And if you're in a World Cup market, December 5th is the big date that you should be paying attention to. And Jamie, which are the countries you want to hope are playing in your market?
Yeah, so this is we've got some more research coming out on this, but there's countries that travel and there's countries that don't. So those countries with the fans that travel the most are like, I'm in Atlanta today, we're hosting group World Cup stages. And like as Atlanta host, we want Germany, we want Argentina, Brazil, England to be selected for games in the Atlanta market. And there's quite a few markets, I won't mention them, where maybe I'll get a good example of like, it is really tough for Iranian citizens to come to the US right now. Iran is in the World Cup. Their fans probably aren't going to be sending a huge number of people into these markets. There are a ton of Iranian and nationals that have sort of migrated to the US over the years, but there's way more Germans, there's way more British that have done that as well. So really rooting for fans that travel en masse because they're going to be the ones that drive really high occupancy and ADRs into your market.
So make sure you're paying attention if you're in a World Cup market on December 5th.
And it is going to drive demand in so many different ways. And then I'm going to end with a PSA, Scott. So what's happening on October 27th?
Airbnb is forcing their new fee structure for those with PMS.
Yeah, so all those uplisting users out there by October 27th, and you'll be forcibly changed from a split fee, if you do have a split fee where the host pays roughly 12%, you pay roughly 3%, to a host-only fee structure of 15% paid by the host. So you need to go in and increase your rates by roughly 18% to make sure that you are getting the same payout and guests are roughly paying the same amount as well. So that is our friendly PSA. If you have questions about that, really on any PMS that you're using, it is only for PMS users. Airbnb is not forcing hosts that don't use a PMS to change that, nor will they in 2025, and we'll see for 2026. But make sure you do that. If not, you will see your earnings greatly reduced.
Really important PSA. Well, great episode, Jamie. I think the summary, maybe the title card for this should say AI holidays, and leaf peeping. That's my takeaway.
Awesome. Scott, it was great. Thank you.
Thanks, Jamie.